In this trading and investment, it is very difficult to find the right information. The information is available in various forms, but it is very difficult for us to choose the information which is relevant for us in making an investment and trading decisions. We have various information like earnings, fundamental analysis, technical analysis, yield, financial ratios, chart pattern, candlesticks. Just the amount of information which is available is abundance. Now, how does one choose the information, or how does one shortlist the kind of information which he or she should use while making a trading and investment decisions? We'll be trying to figure out that, and we'll try to understand that which factors could be used by traders in their regular trading and avoid the noise, that is the information which is not relevant and which actually is available in the market. We'll be trying to figure out and shortlist those factors which can be used to make a trade decisions. Hi there, my name is Hitesh and I welcome you all to YouTube channel of Tradebrains. If you're new to our channel, please comment, like and subscribe, and please don't forget to press the bell notification. So let us begin our discussion by understanding the factors which are of relevance or importance which while making a trade and investment decisions. We'll be shortlisting 5 factors which should be used by us or which should be used by anyone who wants to make a long and prolonged trading career. So let us jump right into our discussion. Now through this discussion we'll be trying to understand as to when to enter the market, and most importantly when to stay out of the market. That is very important. It is always advisable to find out the times when not to enter the market, because there are a lot of times when the market looks like there could be trading opportunities, but it is a plain and blatant noise. There is no trade opportunities. So it is important for us to figure out those opportunities as when to not enter the market. Secondly, learn and understand about the high risk to reward trading opportunities. Now, trading is always a game of risk to reward. Higher the risk to reward ratio, the better it is to take those kind of trading opportunities. It is ill-advised to take trades which has higher risk and lower reward, because if the trade goes wrong, you pay transaction cost also on that, which means your risk is even higher. And to cover that much of losses, we'll have to take 2 to 3 good trades. So it is always advisable to take those trades which have higher risk to reward ratio. Next, we'll also learn about timing of entry. Now, it is all a game of timing. You could be entering at the right price in the market, but if your timing is wrong, when I say timing, it is possible that the market might take a lot of time to make a move from there. We'll also try and learn about the timing of entry. Now, this is very important. You could have spotted the right trade opportunities, but if you enter the market too early, you could actually burn out by the amount of time it takes for a trade to make a move. So timing of entry is even more important than picking the level of entry. So this is what we'll try to understand as to when to time your trade, and we'll also try and understand the art of accepting when you're wrong in the trade. Now, it always happens in the market, you take a lot of wrong trades also in the market, but to be able to accept it that I've gone wrong in the trade is also very important, because if you're not going to accept that you've gone wrong in a trade, then you're going to keep holding on to your wrong loss making positions and eventually have a bigger loss in the market. So to be able to accept that I'm wrong in the trade is also very important. And most importantly, we'll understand the art of profit booking. Now, a lot of traders face with this problem because they are very good at entering the market, they are very good at spotting the right trade opportunities, but they are not so good at picking the point of exit as to when should I book my profit, or as to when should I keep holding to my profit making positions. That is very important. If you get that art right, then you're going to have more profits in the trade and you will be more equipped and you will have a bigger financial gain out of the market. So we'll be trying to focus and discuss these trading aspects while learning this 5-point strategy, which I have personally devised to understand as to when should one enter the market, or what are the factors which one should consider while entering for trading in the market. So the first point, or the first important factor which we all should consider, is pay attention. Now, this is very important. This is one factor which is often discounted in the market. We don't pay attention to minute details. When I say pay attention, I'm trying to understand that pay attention to index. Supposedly, if you are trading in a certain market, it is important for us to understand that what is the overall index sentiment. Even if you're trading a certain stock within the index, it is important for us that we normally don't trade against the market, because if you go against the market, you might be entering too early in the trade, or you might be entering a trade which is actually going in the opposite direction. So even though the script might be right, but try to understand that the index plays a major factor. Just to give you a simple example, if you are trading say Indian equity market, and if you are looking to trade say blue chip companies, it is important for us to understand that what is the current sentiment in the index. Just to give you an example, right now say index is trading around 15,750 levels and the market is continuously making new high on week to week basis. So what does this signal to us? That there is a bullish momentum in the market and we should be looking more for buying opportunities than selling opportunities in the market. So that is what I mean, pay attention to index. Try to understand what the index is trying to say, because index is overall picture of the economy and the share or a stock is just a part of the economy. So a part of the economy will obviously be trying to follow what the index is trying to do, which is what we're trying to say, pay attention to index. Now say, just to give you an example, if the overall sentiment of the market is bullish, so try to look more for buying opportunities than selling opportunities. I'm not saying that the buying opportunities will always give you a profit or selling opportunities will make you losses, but the probability of buying opportunities are better than the probability of selling opportunities. So always go for the sentiment of the market and try to understand what the index is trying to communicate. And when the market is falling, try to stay in cash, because if you take the history of markets in last 20 years also, in 2001 the index was trading at a certain level, it was trading under sub 4,000 levels. Right now we are trading about 15,000 levels. So overall, in a broader picture, the market is always going up, the sentiment is always up because the economy is thriving, the economies are becoming bigger, the globalization has kicked in, which is where the overall sentiment of the market in the long term is always bullish. So always look out for opportunities to buy in the market. I'm not saying that bearish traders don't make money. They obviously trade money, and there are a lot of bearish traders who thrive on making money. But in general, the overall sentiment of the market is inherently bullish because the economy grows, the world grows, which is where the stocks and the indexes also grow. And to reiterate the fact of that, always track the index. If you're trading, say, in the Indian equity market, track indexes like Nifty 50, Nifty 100, Nifty Next 100, maybe BSC Sensex. There are 30 top stocks in that. So if you get a hang of those indexes, you will generally make a decision which is gonna be in line with the market sentiment. And the second important point of contention is that understand the stock structure. Now when I say stock structure, try to understand that what is the overall feel for the share, or what is the overall sentiment of the stock. Is the stock in an upward momentum, stock in a downward momentum? Try to understand the overall structure of the stocks. Now, in general, the overall trend of the market is inherently bullish. As we discussed that the market is always on a rise. The index which is right now, or the Nifty index which is right now around 16,000, might be trading around 30,000 levels in next 10 years. So in general, the overall sentiment of the market is inherently bullish. You might have those 10 years or 3 to 6 months where the market is in a bearish momentum, but eventually the market catches up and the momentum is inherently bullish in the market. So avoid trading those stocks which are actually in a bearish momentum. Now what we understand by is this: the market or the sentiment of the market is inherently bullish. So why trade those stocks, or why invest in those stocks which are in a downward momentum? We have a lot of stocks there, only thousands of stocks in the market which are in an upward momentum. Always try to trade with the sentiment of the index, and always pick those stocks which are in line with the sentiment of index. So we'll make a lot of good trades in the market, and you're going to make a lot of gains in the market. You might make money by trading those shares which are on a downward momentum, but they take a lot of time to go up and they just burn you out, and the cost factor, inflation factor, everything kicks in the stocks. So always try to pick those stocks which are in sync with the sentiment of the index and which are inherently bullish by nature. Just to give you a couple of examples for that. Now if you look at the screen, this is a chart of TCS, and if you look at the overall sentiment of the market is looking inherently bullish. We are seeing regularly market making new highs. You do have spans when the market comes down, but in general the sentiment of the market is bullish. So try to invest in these kind of scripts which are in line with the momentum of the market, which understand what is the index trying to do, and they also try to replicate the performance of index in the share price performance. This is one example of TCS. Now this is an example of Reliance Industries. Now you might argue that there is a big downfall. Now this was during the times of pandemic, that is the COVID times, but in general the sentiment of the market is in bullish. The stock was trading around 750 levels and it is right now trading around 2100 levels. So the inherent trend of the market is bullish, and which is also replicated by the share price performance of the stock. So try to enter those stocks which actually replicate the performance of the market. Now this is the third example. This is the share price of HDFC Bank. Again, look at this stock. This stock is actually in an upward momentum. This is the daily chart, and we're tracking nearly 1 to 2 years data. these stocks are actually replicating the performance of indexes and they are inherently bullish by nature. So which means they are trying to signal towards the positive sentiment of the economy. So this is what I mean when I say pick those stocks which are inherently bullish and which are trying to reflect the sentiment of the economy. These three examples of TCS, Reliance, HDFC, all three of them are having a bullish momentum or a bullish chart, and the market is continuously making fresh high for them. They don't make high on daily basis but on regular basis. Or those are the kind of scripts or shares which you should be looking to invest in the market. Now the next important point is look out for the zones of value. Just because something has come towards a level of support or resistance, don't enter in the market. Look out for the zones and try to figure out those zones where you can enter those trades in the market. Let us understand a little more in detail. Don't buy something because it looks lucrative. Lucrative always doesn't mean it is actually the right product or it is the product with value. Something becomes cheap doesn't mean that it's actually a very good buy. Always look for those shares which actually have the true value and wait for the value zone. Use technical tools, technical studies, technical knowledge, potential zones of support to buy in the market. If all these factors together give you a similar kind of decision, so let's say the technical indicator is giving a bullish momentum in the market is nearing the support zone, plus we have a lot of positive sentiment about the stock, enter the stocks and enter with the full Monty, go for a decent size because those trades have good or higher risk to reward ratios. And look out for zones and not for exact values. It is never possible for anyone to pick the exact price. There are odd cases when you pick up those exact prices, but in general look out for zones where you can enter rather than looking for that perfect price where you should enter the market. Now this is the example of say Wipro. Wipro, again, if you look, the market is in a bullish momentum. It is trying to reflect what the market is or what is the economy trying to do, and look out for the zones. Now if you look at the trend line which we have plotted in the chart, as and when the market comes near the trend line, we see a bit of momentum of buying coming in the market. So the trend line becomes a zone of entry. It doesn't give you the exact price because there are a lot of times when the trend line got breached by little and then the market went up. So look out for the zones where you can enter rather than picking the exact price where you can enter. And again, this is a chart of State Bank of India. Now the market is in a zigzag pattern. It is stuck in a tighter zone of about 100 rupees. So as and when the market comes near the support, there are 4 to 5 times when the market is coming to the support, but it doesn't stay at the exact levels. It trades in that 15 to 20 rupees zone, and that becomes a zone to buy. So which is what we're trying to communicate, that always look for the zone, don't look out for that exact point. It becomes a value buying zone, enter in the market, keep a slightly conservative stop loss and then ride the gain. Because don't get stopped out when you're right, because that's the most painful thing, because you couldn't handle the heat at that time and you got exited from the market. Look out for the zone, enter the size which suits your trading style and then wait for the trade to make a move. Now perhaps the most important point of our discussion is deciding when to buy. Now just because something has entered a zone of buy doesn't mean you buy it. It might be the right price. I also told you earlier also, it might be the right point of entry, but the amount of time it spends there burns you out and you get exhausted, or then you either book your losses or you book a minimum amount of profit, but the potential is so much more than that. So don't enter just because in the value zone, enter when the timing is right. One needs to wait for the trigger points. Now trigger points are those points which give you confirmation that the trade is ripe and it's about to make a move. The trigger points could be in the form of candlestick pattern, in the form of technical indicators, or in the form of market getting out of the zone and getting into a fresh zone of rally in the market. So wait for those trigger points, wait for those zones and then enter the market. Now this is the chart of ICICI Bank. I've drawn two trend lines. One trend line when the market is coming from up to down, and the second trend line when the market is getting supported and going up. Now if you look at this trend line, the market was in a continuously falling momentum and it had fallen nearly 40% from its high. It was trading around 350 levels and it came near the level of 200, and which is where for the first time we saw market breaking the trend line which was coming from top to bottom. So it looked like that the selling momentum has fizzled out and you could see the market making higher highs and higher lows. So which is where it became a trigger point. When I say trigger point, the breaking of trend line was a trigger point in this shares, and then if you had entered around the level of 200 also, it was continuously making newer highs, or it was actually making higher lows, and when we could see trend line formation at the bottom as and when it came to trend line, and we saw buying momentum come in the market. So which is what I mean when it gives you trigger points. Trigger points doesn't mean something enter into value zone. The value zone is important, but trigger points has to complement the value zone, and which is where you get right trading opportunities in the market. Now again, this is the chart of Tata LXC. The Tata LXC is actually trading in a zone. The zone is upward momentum. The momentum is inherently bullish, but it is actually not making the right breakout. And when did the breakout happen? The breakout happened at this point when it broke the zone of 2100. We saw the market getting out of the zone, and then we saw bam, massive rally in the market. Within a matter of 2 to 3 months, it gave you nearly 100% return on the trade. So that is what we understand when we say wait for the zone to be broken out, or wait for the trigger points which tell you that the zone is about to be broken and we might see fresh momentum. The zone becomes a point where you try to see or analyze the market and wait for the entry points or entry trigger points. And once those trigger points come in the market, you enter the market and trade a trade after that. And now the next point which we'll be talking about is that exiting the trade. The exiting the trade could be in the form either you're wrong on the trade or you're right on the trade. First, we'll try to understand when you're wrong in the market, how do you handle that situation? When you're wrong, the most important thing is to accept when you're wrong. If you don't accept that your trade has gone wrong, you're going to have heavier losses. Accept that where your view has gone wrong and you have made a wrong trade decision and you're going to lose money in the market. Even the most obvious and the perfect trade setups go wrong in the market, and which is very okay. Sometimes the market signals, okay, there's a bullish momentum coming in the market. The indicators are giving a buy signal. The candlestick formation is like a bullish Marabozo or a doji at the top of the candle. It gives you all the correct signals. But even then, what happens? The market came down and your views have gone wrong. So it is okay to take those kind of trades, go wrong, accept it and move out of the market and wait for the next trading opportunities. But the most important thing is that don't get stopped out from the market when the trade is brewing. When I say brewing, it is in the process of getting ripe, which is where the timing is important. Enter the right time and don't get stopped out just because you couldn't handle the basic heat from the market. Get stopped out only when your trade is wrong. Don't get stopped out when the trade was in the process of building up and was about to make a move. This is very important. Hold on to your positions unless you're wrong. It might sometimes take time for a trade to make a move, but when it makes a move, it will be very good results in the trade. And always have a buffer stop loss. When I say buffer stop loss, don't have huge stop loss which actually disrupts your risk to reward ratio. Have a stop loss which is within the risk to reward ratio, but always have a slightly conservative stop loss, because sometimes trades have a tendency to just give a false break and then make a move. So don't get stopped out in the false break. Have a slightly conservative stop loss and then ride the gain in the market. Now the next important thing about exiting is, when do I exit? When I'm right in the market. The general idea of the trade is to take a right trade, and when you're right about the trade, what do you do? How do you exit it? If the target is preset, if you've already decided that this is the point when I want to exit the market when the market reaches there, and don't worry about what if the market makes a bigger move. No, that is not the objective with which you enter the trade. The objective was that this is my profit, this is my loss. If the market hits my profit, I'll exit. If the market hits my stop loss, I'll exit from the market. If your profit is achieved, exit from the trade. And if you're trading, say based on swing trading, then exit before or near the end of the swing. Don't wait for the swing to be completed. Just exit before the swing is completed, because sometimes market goes near the swings and makes a U-turn and people get stopped out. So exit near the swing. Don't wait for the swing to complete and then I'll see what to do. Have your target set up. Keep your profit targets there. Exit once your target is achieved. Now, the third important point which I have not mentioned on the slide I want to talk to you about is that sometimes you enter a trade and the market gives you the momentum bullishness in the market and your views are right and the market is going up, but you don't exactly know when to exit from the market. I don't know where to keep my profit target. Then in that case, use trailing stop loss. It is one of the most important form of stop loss which is not often talked about. Keep trailing your stop losses as and when the market goes with the momentum or in the momentum, and keep trailing the stop losses up as and when the market keeps going up. Eventually the market will make a downtrend, and as and when your stop loss is hit is when you exit from the trade. So you've made decent gains in the market because you're able to capture the bigger move and you didn't have a preset profit target. So these are the three kind of strategies which you should use if you're right in the market. First is, if your target is preset, exit from the market once the target is achieved. If you're trading based on swing trading, exit the market just before the swing is complete. And if you don't have a view on the market about when should I exit, keep trailing your stop loss and ride the gains over a period of time. Now this is a chart of say Bank of India, and the market is trading in a zone. There are swing highs and swing lows. First the market comes near the swing lows, goes near the swing highs, again comes near the swing lows, and you see okay that the market is spending time here and you see green candle formation which signals bullishness. So you enter the market there, keep your stop loss below the previous swing low and keep slightly conservative stop loss. Now the next point is, where do I exit? If you had waited all the way for the swing high to be achieved, you would have just missed your profit target. So have your profit target just below the swing highs or slightly below swing highs. Exit if you see more bearish pressure coming in, exit from the market, and what you saw, the market came down again. So exit when you've made decent profit and you feel that the market is again going to reverse, exit from the market and make a gain out of it. So that was it from us in this video, where we understood 5-step guide to understand as to when should one enter the market, how to pay attention, how do you keep a stop loss, how do you keep a profit target, and most importantly, exit from the market when you're right, and how do you ride the gain when you're right in the market. So I thank you for your patient hearing. I'll again see you future videos of financial education. If you have any question, post all your doubts in the comment section. I'll be more than glad to answer. Thank you so much.